So thank you very much, Daniel. Thank you to the Adam Smith Institute and to the Institute of Economic Affairs for the very kind invitation to the Freedom Week. I wish we could do it in person, but this is also fine with me. The topic is indeed, well, it's impossible to address. I will do my best. So I will do an introduction of what central banks do, what they should do and what they shouldn't do. And then, of course, I would be very happy to take your questions and comments during Q&A. Again, more than happy to take your feedback, questions, as you want to put them afterwards. So monetary policy and central banks' roles in modern economies. I'm afraid that I will have to just to refer to our time, even though I will make some incursions into economic history, because economic history is very much important, very much needed in order to understand what's going on in central banking nowadays. So what is a central bank? What does a central bank do? If you put this question to a first-year undergraduate student in economics or an A-level student in economics, the most popular answers will be, well, it is the institution in charge of setting interest rates. So in this sense, the central bank is taken as a sort of an interest rate setter. And by this, I mean their interest rate, as if there were only one interest rate in the economy. So of course, that's not right, but that's one of the most common answers in among our even graduates in economics. Other people say, well, is this the institution in charge of printing money? And they usually refer to paper notes. So it's indeed a monopolist in a country in the issue of legal money, is narrow money or the monetary base. But that's not at all. That's not at all the total amount of money we use in our daily transactions. So that's a very incomplete, let's say, answer too. Others refer to the role of central banks as the monetary policy maker, independent from the government, usually in charge of or aiming at maintaining price stability. Then we need to define which prices are included in the remit of central banks. And some others say that central banks also should foster economic growth, as in having a GDP or an unemployment rate target. Unfortunately, because of the different crises we have suffered from in the last few years, now a very common answer is yes, is also the institution that intervenes whenever there is a crisis, a banking crisis, and most refer to the roles of central banks in bailing out banks. Well, that's not accurate. Yes, they do intervene in times of crisis, but they don't really or necessarily have to bail out banks. So these are the sort of topics that I would like to address during the presentation. Forgive me if I go to, perhaps if I cover them too quickly, but again, I will be more than happy to cover them in more detail during Q&A. So let me just clarify some things beforehand. What central banks have direct control over is a very short nominal interest rate, is the overnight interest rate they provide lending to the banking sector. But this is just a interest rate, is the policy rate. There are thousands, millions of other interest rates they don't control. And indeed, as I said, they do control the total amount of money, cash they issue, and the total amount of reserves banks hold. But that's a very narrow definition of the supply of money. That amounts, of course, depending on the country, to possibly 5–10% of the total means of payments used in our modern economies. So the other 90% of the means of payments created in the economy are created by, indeed, the market, by commercial banks. So we need to make a distinction between a narrow definition of money, indeed under the control of the central bank, versus a broader definition of money that is very much affected by the ability and willingness of commercial banks to expand their balance sheets. And in the same vein, you need to know that the most important interest rates we need to focus on in order to make assessments about real investment, consumption decisions made by economic agents are long-term interest rates and real interest rates. And both are very much determined by market expectations of inflation. Indeed, the central bank can affect these expectations, but they are not determined by the central bank, but by the market. That's why it's so important to have a credible policy rule for the central bank to be able to affect market expectations. But again, sorry to repeat myself so many times, the central bank only affects one short-term overnight nominal interest rate, the so-called policy rate. And there is another misconception about what central banks can do. Indeed, they can affect the price level over time, over the medium to a long term, but only in that time horizon. In the short term, there are plenty. There is a myriad of factors explaining short-term fluctuations in prices. Those are out of the scope of the central bank. That's why in the mandate given to the central bank, they should be focusing over the medium to a long term. And they shouldn't intend to stabilize any single fluctuation in prices in the short term. That would be very destabilizing for the economy. And also something we need to remind ourselves and to remind politicians all the time, central banks, monetary policy, they don't create jobs per se, not directly. The best we can do is to try to stabilize the rate of growth of money in the economy, to create the best conditions for the economy to flourish. Why? Because real output, real variables, real GDP, the unemployment rate in the economy, at the end of the day, is determined by the supply side of the economy, supply side factors, capital, productivity, the amount of your labor force, how skilled your labor force is, innovation, and so on. Now that we have the framework a bit clearer, let's start by listing and explaining, if only briefly, the central bank's functions in a modern economy. Let's start with the relation between the central bank and the government. Well, here's when I'm going to introduce a bit of history. The very establishment of most modern central banks was made in a way that it became very clear, this coalition of interests between the state, the crown at the time, and a private bank. In the case of the Bank of England in 1694, it is very, very clear. So it was a deal between, again, the government at the time in need of finance to pay for the war against France, and a private bank. So the newly established Bank of England was given a series of advantages against its competitors. First of all, the monopoly power to issue paper notes in the London metropolitan area. Then it was that area was expanded and extended as the money given to the government was increased. So yes, the monopoly power to issue paper notes, the exclusive holding of government money or accounts, that's a big business for a single market player, and also the monopoly of limited liability in England. So effectively, that gave the Bank of England a huge advantage against its competitors. The three of them constituted the basis of the privileges given to the Bank of England in exchange of what? In exchange of a loan to the government. £1 million at the time to pay for the wars against France. So at the very essence and origin of central banks, in the case of the Bank of England for sure, you have this very special connection between the crown, the state, the government, and the newly established central bank. So here you have a scene, you will see in this presentation that I very much enjoy using caricatures of the time to explain how things happened at the time. Here you have a privately owned Bank of England, a scene in the 19th century. In the early 19th century, you could see people just coming into the bank to benefit from the services of the bank. In particular, under the gold standard rule, anyone could, with a pound note, could go to the window of the Bank of England. Here you have them, asking for the exchange of the note for gold. So indeed, it was a privately owned central bank providing services to the economy. This is just a reminder that central banks were and have been all these centuries banks in the first place. It's not just a bureau or an administrative institution in charge of setting interest rates. That's very narrow. The central banks do much more than that. And in times of crisis, we have realized how many other services as banks they do undertake. And here you have an extract from an excellent book that I very much recommend you to read on the history of central banks by Vera Smith, a pupil of Friedrich Hayek. She was the PhD student of Friedrich Hayek back in the 30s. And she wrote a marvelous book available online, The Rationale of Central Banking. And she has several chapters on the establishment of modern central banks in different countries. Here you have an extract to explain the establishment of the Bank of England. But if you're interested in other central banks, please do read this book. It's an excellent book. And again, going back to this special or tricky relation with the government, here you have a marvelous caricature of the Bank of England, depicted here as the old lady of Threadneedle Street. That's the street where the Bank of England is on. And since then, this is taken as the nickname of the Bank of England, the old lady of Threadneedle Street. Here, she's been assaulted or attacked by the Prime Minister at the time, William Pitt the Younger, at the end of the 18th century, 1787, who was very unkindly asking for money to the central bank to pay for their wars against France. So indeed, in times of crisis, and this is not new at all, the government tries to get funding, special or privileged funding from the Bank of England or the central bank. This is not new at all, and we have seen it in many other crises. So here you have the size of the balance sheet of the Bank of England in the aftermath of the global financial crisis. So you can tell that the volume or the size of the Bank of England, this is a percentage of the GDP, of the UK GDP. It was fairly stable before the crisis, around 5 to 6%. And then obviously, because of the reaction of the Bank of England to the crisis, it exponentially increased in the years afterwards. So this area, this purple area, is the repos operations. That's the exchange of assets between the banks and the central bank and the Bank of England when banks are asking for funding to the Bank of England. So the extent of the size of the gilts of the government bonds in the hands of the Bank of England under these repo operations expanded quite considerably, as you can see. And also, all other purchases of government bonds, this big red area, in the balance sheet of the Bank of England. This means that both via the normal open market operations and the extraordinary asset purchase operations conducted by the Bank of England in the aftermath of the crisis, the Bank of England was indeed helping out the government. It was providing finance to the government in times of crisis. How much? Well, that will be given by the size of this huge area, up to 25% of the GDP at the time. So it is indeed meaningful to look into this relation between the central bank, the Bank of England in this case, and the government, especially in times of crisis. And again, there is nothing new. It has happened from the very establishment of the Bank of England. So just to summarize this first part of the presentation, the central bank is not just a bureau, it is indeed a bank. And a bank provides financial services to the community, to the economy, to the government, as we saw, and we will see to the other banks as well. And it has very strong links, to say the least, with the government. It is indeed the bank of the government. What about the other services, the other functions undertaken by the central bank? Well, in order to understand these functions, we're going to go through the roles of the central bank in the creation of money in a modern economy. And indeed, we need to go back to the time of the gold standard rule in order to understand better how money is created now and how unlimited the power of the central bank is now as compared to only 100 years ago. Well, here you have again another caricature by this master, James Gilray, depicting the same gentleman as before, William Pitt the Younger, that Prime Minister, the UK Prime Minister that I referred to before. And this is the representation of the power of the state to create money under the gold standard rule. So the belly of the state, the government or the Bank of England, is the gold reserves held at the Bank of England. And this is the King Midas in reverse. Why? Because if you know the myth, Midas converted everything he touched into gold. But this is in reverse because this gentleman is converting all the gold reserve, well, not all, part of it, into the issue of paper notes. How much? It could not do as much as they wanted. There had to be a ratio between the amount of money issued by the central bank and the value of the reserves held at the Bank of England. That was given by the gold standard rule. Why? Because at any point in time, any money paper note holder of a pound note could go back to the Bank of England and redeem that note for gold. That was the so-called convertibility rule. At any point in time, anyone could go to the window of the Bank of England and ask for the equivalent of one pound note, or whichever the denomination was, for gold. That made the Bank of England very cautious, and that imposed a very clear limitation to the Bank of England as per the ability to issue paper notes in the economy. Now that system is gone. Please don't try to go to the Bank of England and ask for your gold back. They wouldn't give you any gold. They will give you another, possibly newer note, nothing more than that. So now the ability of the state, of this King Midas, to create money is unlimited, potentially unlimited. There is technically no limit for the monopolist of money to create as much money as needed. Of course, this doesn't mean that it has no consequences, but it's important for us to remember that under the current circumstances in which money is 100% fiat, which means it's not backed by any other asset, any other precious metal or any other, in this system, the ability of the monopolists of money to issue paper notes is unlimited, and we need to constrain that ability. Why is that? Because again, in times of crisis, people would take back the paper notes. In the case of the gold standard, here you have them taking bags of paper notes on the shoulders to redeem them for gold. And here you have the governors, the directors of the Bank of England at the time, asking people to stop because they wouldn't have enough gold to honor those payments. Now there is no such an obligation, as we know. We cannot appeal to this convertibility rule, but if there is too much money in circulation, we know that in the end, there will be inflation. That's why we need to give central banks a very clear remit in terms of the amount of money they are able to produce. And this is the result of the application of a clear rule as regards the running of modern monetary policy. Of course, at the time, it was not called a monetary policy, but just the fulfillment of the gold standard rule, the convertibility rule. From the time of the aftermath of the Napoleonic Wars, the early 19th century, to just a few years before the beginning of the First World War, so prices were very stable for nearly a century. And I don't mean inflation, I mean price stability, price level stability. So basically, an average basket of goods and services, a representative basket of goods and services, the prices of that basket here in the 1820s would be very similar to that price, that value, 90 or 98, sorry, 90 years later, or even 100 years later. That's how effective a monetary policy rule can be under the gold standard. And that's something we haven't had afterwards. You can tell that after the abandonment of any restriction on central banks to issue as much money as they could after the Second World War, we have had an exponential growth of the price level that we have only mitigated with the adoption of inflation targeting rules from the 1990s onwards. But this is not even close to the kind of stability we enjoyed only 150 or 200 years ago. So what this diagram is telling you is that indeed we need to tie the hands of the monopolist of the government or the central bank in order to maintain the purchasing power of the currency over the medium to a long term. Which are those functions, other functions I referred to before, of the central bank as the bank of banks? Well, first of all, the Bank of England provides what is called the monetary standard of the economy, the pound, the currency. It is just the asset used by commercial banks to make their businesses, as simple as that. And it has to be, again, the value of this asset ideally has to be as stable as possible in order for banks to be able to increase their businesses, for the economy to flourish. So what's the relation between commercial banks and the Bank of England? Well, the Bank of England provides both regular lending and extraordinary lending in times of crisis to the banking sector. So at the beginning of the year, the Bank of England would issue a calendar of set dates in which the Bank of England would lend money, would run the so-called auctions of liquidity to the commercial banks in the country. It is indeed an auction of liquidity. It would be the representatives from each commercial bank in the country asking for X amount of money at an X interest rate. And then it would be for the Bank of England, for the monopolist in the supply of money, to decide how much money it wants to allocate or which price, which interest rates wants to charge for that money. So that's literally an auction of liquidity. They used to be conducted on site, and now obviously it's conducted electronically. So how those regular lending operations are conducted? Through the so-called open market operations. This is an exchange of government bonds, gilts in the case of the UK, for the new money created by the Bank of England at an interest rate. So the policy interest rate is the price paid by the banking sector for accessing this borrowing facility of the central bank. But remember, these are repo operations, repurchase agreements operations. After an X number of days, normally it's a week in terms of no crisis, or 2 weeks, then the operation will be reversed. So it's not a permanent addition of those bonds into the balance sheet of the central bank. It is not. And also, in times of crisis, the central bank can provide extraordinary lending to the commercial banking sector. One way in which this extraordinary lending can be provided is by extending the maturity of these lending operations and also the amount of these lending operations. But we'll get back to it in a minute. Another way in which central banks can provide lending to the banking sector is easing the collateral they ask for in these open market operations. So they wouldn't just take public bonds, but other commercial paper or privately issued assets in order to provide lending. But again, I will get back to this in a minute. Also, as a bank, every commercial bank in the land in the UK would have a current account with the Bank of England in order to settle interbank balances at the end of the day. So what the central bank is doing is to provide clearing facilities among all the commercial banks operating in the country. This makes the operations among commercial banks to settle much easily and efficiently. So that's another service provided by the central bank. And since the central bank is indeed providing regular lending and extraordinary lending to the banking sector, as any other bank would do, they also want to supervise the books of the banks and to regulate what they can do and what they cannot do. So this is common practice in banking. If you ask for a mortgage to your bank, they will ask you for your financial records. Well, this is something that the Bank of England does on a regular basis with the banking sector. So in particular, what they will look into many more details, but they will look into the reserve ratio of the commercial bank or capital requirements, and also the liquidity ratio of the banking sector. So indeed, this is just for me to tell you that indeed it is a bank providing services not just to the community, to all of us, all the holders of paper notes or money, but also to the government and to the banking sector. That's very important for you to remember. It is not just a bureau in charge of an interest rate. It is much more than that. It is a bank. What happens in times of crisis? Well, here you have the old lady of Threadneedle Street. 100 years later, you can tell she has aged a little bit. And those 5 boys there, they are bankers. They have been speculating in financial markets. You can tell that they hold cards in the hands. So what the caption of the caricature reads is, you've got yourself into a nice mess with your precious speculation. Well, I will help you out of it for these once. Well, again, this is another example, in this case, the bearing crisis of 1890s, of the central bank stepping in case of a banking crisis, providing liquidity to the banking sector, providing lending facilities to the banking sector. So again, nothing new with what has happened in the last 10, 15 years, with the central bank intervening in a crisis, in a banking crisis. However, we need to remember that this is not a bailout. This is not a gift. This is lending. Lending given by the central bank, by the Bank of England, against collateral. So what the central bank, the Bank of England, has been doing now for many years, since the 1860s onwards, is to apply what is called the classical criteria of the lender of last resort of the economy. So according to Walter Bagehot's excellent book written in 1873, Lombard Street, that I very much recommend you to read, in times of a banking crisis, of a liquidity crisis, what the Bank of England should do is to step into the market to lend readily and as much as needed. So an unlimited amount of money to banks with liquidity problems. So that means that we are not bailing out an insolvent bank. Only a bank with liquidity, with cash issues, but enough collateral, therefore solvent, will be able to apply to these lender of last resort facilities. Why? Because the second condition of this intervention is that the lending must be provided against collateral. So as long as the bank is able to provide collateral, the Bank of England should be willing to provide lending. Why? Because that lending will be honored, will be paid back by the bank. And also it should charge an interest rate higher than that in normal times. So indeed, it's a lending operation, and you want to discourage the commercial bank from engaging in risky operations in the future. So you are trying to avoid a moral hazard problem here. So indeed, you address the crisis. You don't want that liquidity crisis affecting one bank to be spread out to the whole banking sector. That will provide a financial instability, a financial catastrophe in the country. And the fractional reserve banking, if one hears that a bank is suffering from problems, if those problems are not being addressed or sorted out, everybody else may think that the bank is in trouble. And what the regulator must do, and the fractional reserve banking, again, is to step in, provide a limited lending against collateral, but at higher than normal interest rates. Hopefully, those loans will be repaid a few days or weeks later, and there will be no confidence crisis or contagion of a financial panic in the economy. That's how the system should work. And the fractional reserve banking, you need a lender of last resort, but to operate in a sensible manner against these three criteria, classical criteria established by Walter Bagehot and even before him. So now that we know a bit more about the roles played by modern central banks in the economy, let me just finish my presentation with few slides only on what should central banks focus on. My main message here is to remind you that central banks cannot do all. They only control few instruments in the economy, and they should not be given too much of a remit, of a broad remit. That would be a mistake. So here you have a very famous quotation from Milton Friedman, in which he stated in the 1970s that inflation, and may I say deflation, is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. So here you have what I believe should be familiar to you, the expression of the quantity theory of money, the quantity equation. And these indicators are in rates of growth. So the rate of growth of money plus the rate of growth of money velocity should be equal to the rate of growth of prices plus the rate of growth of transactions, here proxied by the GDP. So the higher the left-hand side of the equation, the higher the amount of money, over time, the higher nominal income will be. That's how you should be reading this equation. And of course, V is the key factor here. It's money velocity, it's the inverse of the demand for money. This ratio, the amount of money that you want to spend, stays very stable over time. But of course it changes. It does change in a crisis time. Like now, for example, we've seen that money velocity has dropped quite notably. So the demand for money is really high in terms of uncertainty. But once the uncertainty is gone and people can return to, let's say, normal, if you had increased money, the amount of money too much during a crisis, that money will not disappear magically. That will be spent. So what I'm trying to say is that if in the times of a crisis, you increase money too much, just because it's not being reflected in the short term in higher prices, that doesn't mean that it's not going to be inflationary over term. That's a very important lesson by Milton Friedman and this approach to prices. Here you have the empirical validation of this theory. This is a chart from the institute where I work, the Institute of International Monetary Research, in which you have two lines. The golden brownish line is the average rate of growth of broad money, M2 or M3, depending on the country. And the other one, the blue line, is the average rate of growth of nominal GDP. So real GDP at current prices. So you see, of course, a correlation between these two. So countries with very low and moderate rate of growth of money, such as Japan or Germany before the euro, or France, the United States, they have benefited from low rates of growth of money and also quite stable nominal GDP, which means quite stable prices. And on the other side of the spectrum, you have much more unstable countries or currencies, sorry, like Turkey, Mexico, Russia, with much higher rates of growth of money over time and much higher inflation or nominal GDP. So indeed, this relationship holds, but again, over the medium to long term. There will be occasions in which there are circumstances in the short term that doesn't show this relationship, but over time it does work. Here you have just a figure from Robert Lucas, Nobel Prize speech in 1995, in which you have the correlation between, well, inflation or the rates of inflation and money growth. So the higher the amount of money in the economy, the higher the rate of inflation is. And also a very good one, in my in my view, the correlation between money growth, broad money growth here, M2, and real output growth. So those countries with lower money growth here benefit from quite a good rate of output growth as well. Whereas those outliers here, like these ones here, or indeed this one here, they have issued too much money and they don't benefit from higher real output growth. So basically what these diagrams are telling you is that what you can do, the best you can do to benefit the economy, the real economy, is to maintain the stability in the rate of growth of broad money. That's the best you can do for the economy to flourish and to prosper in the future. Finally, you have here a reminder of what we are suffering at the moment. So both lines represent the rate of growth of money. One is the annual rate, the other one is the annualized rate in the last 3 months. So this is just for you to know or to realize how extraordinary it is what we are witnessing in the last few months. So from an average rate of growth of money in the last, 50 years of 7% that the US has been having, now we have a rate of growth from, in the last year of 25%, even more now with the latest data, 27%. So that's truly extraordinary. If you believe that there is a relation between the amount of money in the economy and inflation and the business cycle, you should be alarmed by these figures. So what we are indeed saying from the Institute of International Monetary Research is that this increase in the amount of money circulation is not going to be neutral. It will have effects. Maybe we don't see them now, but in the next 2-3 years, we will. And this is something we just wrote a report about for the IEA, and you can access the publication there if you like. I would be more than happy to take your questions about it. And this is just a slide on some, what I think is useful references in money and banking. Of course, the page of the Institute, I believe, is really good. It provides plenty of research and analysis on the monetarist tradition of prices. We have the so-called Money Map project, in which we show the relation between money and nominal income, research papers, plenty of information that you can benefit from. And also in our YouTube channel, you can access all the seminars and webinars that we are running. An excellent resource is also the Cato Center of Monetary and Financial Alternatives. If you're interested in new means of payments, that's a very good website to access. I also have, sorry for quoting myself, a blog on money and central banking issues, the old lady of 3 Mill Street, if you want to have a look. And also there are many others, but the Mercator Center, there are plenty of information. And Lars Christensen, an excellent macroeconomic economist, he has a wonderful blog called Market Monetarist. So if you want to access these resources, you will find plenty of information that will be beneficial, I suppose, for you and your studies. And again, if you want to be in touch with us, you may want to subscribe to our monthly monetary report and our newsletter. So you can join us in our events. There you have the details to do so. And thank you for your attention. I would be more than happy to take your questions now.